Ever wondered how a country manages its money on the global stage? Or what truly makes a currency's value, go up or down? Get ready, because today we're embarking on a fascinating deep dive. We're going into the intricate world of foreign exchange in India. It really is a story of transformation, control, and eventually opening up to the global economy. Our mission today is to take these complex financial topics, and there are quite a few, everything from India's dramatic policy shifts to the immense global forex market, the unseen forces moving exchange rates, India's financial shock absorbers and its reserves, and the ins and outs of foreign investment and international borrowing. And we want to distill them into clear, actionable insights for you. We want to give you a shortcut to being well-informed, complete with some surprising facts and a practical understanding of how it all sort of connects. So let's unpack this incredible journey. India's relationship with foreign exchange, well, it's been nothing short of a dramatic transformation, almost like a coming-of-age story for its economy. Picture this, the era before 1991. Foreign exchange was seen as this deeply scarce resource, something to be strictly guarded. This control, it was initially formalized by the Foreign Exchange Regulation Act, or FERA, back in 1947, and that was strengthened again in 1973. FERA gave immense statutory power to the Reserve Bank of India and the central government. I mean, they controlled pretty much everything, from dealing in foreign exchange to payments outside India, even the import and export of currency, transferring securities, or acquiring property both inside and outside the country. The Indian forex market was, well, to put it mildly, deeply regulated. Foreign exchange was considered a scarce commodity, partly because, frankly, Indian companies were often inefficient and struggled to export enough to earn it. And here's a truly wild fact from that era. All foreign exchange earnings had to be reported and actually surrendered to the RBI. And crucially, violating FAIR wasn't just a fine. It was a criminal offense punishable by imprisonment. Can you imagine operating a business, or even just living, under that kind of control?
That really highlights the huge philosophical shift that took place later. What's striking here is how that entire mindset just changed. Recognizing a vastly different global economic environment, India initiated a complete overhaul. This led to the Foreign Exchange Management Act, or FEMA, in 1999, which officially replaced FARA. It became effective from June 1st, 2000. The primary objective of FEMA wasn't just, a regulatory update. It was a fundamental move to liberalize foreign exchange transactions. The overall focus shifted towards making the Indian economy far more export-oriented and, critically, increasing foreign exchange earnings. Its impact was significant. It really expanded the list of activities for forex transactions, essentially freeing up cross-border trade and investment, and India's export-import policy was liberalized considerably. A fantastic example of this market development, kind of showing India's new confidence, is how currency futures involving the Indian rupee and US dollar began trading on the National Stock Exchange in 2008. That was a direct signal of this new, more open environment.
That shift to FEMA sounds like a monumental change, really opening up India in a way that was, well, unthinkable just a decade earlier. But once India opened its doors, how did this newly liberalized economy actually interact with the vast, interconnected world of global finance? That's where the foreign exchange market comes in, right?
Yeah.
When we talk about the foreign exchange market, FX, currency, or forex, we're talking about that global marketplace where participants buy, sell, exchange, and speculate on currencies. Its sheer scale is truly astounding. It is, without a doubt, the largest market in the world by trading volume. Just think about that for a second. It dwarfs everything else.
And the players are incredibly diverse. You've got commercial banks, central banks like the RBI, other financial institutions, large corporations, investment funds, and even individual retail traders now, not to mention money transfer and remittance companies. Everyone participates for various reasons. For some, it's straightforward trading, buying, and selling currencies for short-term profits. For others, it's pure speculation, taking positions based on anticipating future price movements to make substantial gains, though it inherently carries a high risk of loss. You need to know what you're doing there. Then you have investment, where entities buy a currency for long-term gains. This is especially crucial for cross-border investments into other economies. And, very importantly, there's hedging. This is essentially taking offsetting positions to reduce or eliminate the risk of adverse movements in exchange rates. It protects international transactions from those unexpected currency fluctuations. It's really about achieving stability.
So what truly sets this market apart? Because it's not just big. It functions in a fundamentally different way from, say, the stock market, doesn't it?
You're absolutely right. The core differentiator is that it's essentially open 24 hours, almost continuously from Sunday in Sydney right through to Friday in New York. This round-the-clock operation makes it incredibly highly liquid because there's always someone, somewhere, trading, immense global participation. And because of that liquidity, it often means relatively low transaction costs, low margins. It also offers high leverage, allowing investors to significantly multiply their exposure with relatively small capital. But again, that amplifies both gains and losses. And as you mentioned, its trading volume surpasses all other financial markets. It's just a colossal engine of global finance.
Okay, we've laid out the big picture of how India opened up and the massive global market it now plays in. But how does it actually work on a day-to-day basis? What are the sort of practical mechanics, the plumbing, and these unique bank accounts that enable cross-border transactions? Well, when it comes to foreign exchange operations, you primarily deal with two types of markets that facilitate these exchanges. There's the spot market or current market. Here, transactions are completed immediately or on the spot, usually settling within 2 business days. It's like buying something right now. Then you have the forward market. This is a derivative market where an agreement to buy or sell currencies is made today, but the actual exchange happens on a future date at a predetermined exchange rate. This is really useful for businesses wanting to lock in prices for future transactions to avoid currency risk.
Exactly. And when banks are managing funds for each other across international borders, they rely on some very specific account types. You might have heard the terms nostro, vostro, and loro accounts. They sound a bit complicated, but the Latin roots actually make them pretty clear once you break them down. Okay, so a nostro account, that's from the Latin for ours, is simple. It's your bank's money held in another bank in a foreign country, in that foreign currency. Think of it like this. If State Bank of India, an Indian bank, maintains a current account with Citibank in the USA, denominated in US dollars, SBI refers to that as its nostro account. It's their money held by another bank over there.
Got it. Ours. So then vostro must be the flip side.
Exactly. Vostro account, from the Latin for yours, is when a foreign bank opens an account in your domestic bank in your local currency. So if Deutsche Bank from Germany opens an Indian rupee account with State Bank of India here in India, SBI would refer to this as Deutsche Bank's Vostro account. It's the foreign bank's money held by the domestic bank here. Yours.
Okay, nostro is ours, vostro is yours, and loro, that sounds like a third-party thing maybe?
You're on the right track. Loro account basically means our account of their money with you. It gets a bit more complex. This is a current account maintained by one domestic bank, say SBI, for another domestic bank, like PNB, but held at a third bank. It's a third-party account. So to visualize it, imagine SBI needs to facilitate something for PNB involving Axis Bank. SBI might use an account at Axis Bank, which is actually PNB's money being managed via SBI. From SBI's perspective, this is a Loro account. It's like Bank A managing Bank B's funds through Bank C. It establishes a clear chain.
Right, that makes sense. Beyond these specific bank accounts, you also have vital facilitators in the market. Authorized money changers, or AMCs, and authorized dealers, ADs. AMCs are entities authorized by the Reserve Bank of India under Section 10 of FEMA, specifically to deal in foreign exchange for certain purposes. And it's crucial to know that no one can do money-changing business without an RBI license. You can't just set up shop. ADs, on the other hand, are typically banks and other institutions licensed by the RBI to act as authorized dealers. Their main objective is often to provide easier foreign exchange conversion facilities for a wider public think travelers, tourists, non-resident Indians. They effectively expand the network of forex access across the country. Okay, so the value of a currency. It can feel like this mysterious force, fluctuating daily, making headlines. What are the powerful forces that truly determine an exchange rate? It's like a complex dance, isn't it, with lots of partners?
Absolutely. It's driven by several key factors. One of the primary drivers is the balance of payments. Simply put, if a country's foreign exchange earnings are less than its foreign exchange expenditures, say, due to a large trade deficit where it imports more than it exports, that increased demand for foreign currency will typically cause the domestic currency to depreciate. It weakens. Then there's the interest rate. Higher domestic interest rates tend to attract foreign capital as investors seek better returns. This increases demand for the domestic currency, which, in turn, causes it to appreciate or strengthen. Conversely, lower rates can push capital away. Inflation also plays a huge role. Higher domestic inflation means the domestic currency's purchasing power erodes faster at home. This makes it less attractive on the global stage, ultimately leading to its depreciation.
And money supply, I imagine, feeds directly into that inflation picture, right? Too much money chasing too few goods.
Precisely. An excessive increase in money supply can certainly fuel inflation, which inherently devalues the domestic currency. Basic economics there. Speculation is another big one. If market participants anticipate future appreciation of a currency, they'll buy a large amount of that currency now, hoping to profit later. This buying pressure itself drives up demand and the exchange rate, sometimes even before the underlying economic fundamentals fully justify it. And of course, we can't forget government or central bank intervention. Agencies like the RBI in India actively intervene in the market. They do this by buying or selling foreign currencies to influence the exchange rate, or perhaps more often to check excessive fluctuations to smooth things out. For instance, you'll often see reports that the RBI is selling dollars when the rupee depreciates fast to try and curb its rapid fall. Finally, perhaps the most fundamental factor in the long run is the strength of the economy itself. A strong economy with a high economic growth rate provides fundamental support, a kind of strong momentum for the local currency, generally leading to appreciation over time. It's the bedrock.
If we connect this back to the bigger picture, understanding these determinants really helps us appreciate how India's own exchange rate policy has evolved over decades. It wasn't always this managed float system we have today, was it?
Not at all, that's right. Historically, right after independence, India adopted a fixed exchange rate regime. It was initially pegged to the pound sterling due to strong historical ties. This was largely within the framework of the Bretton Woods system that governed international finance back then. In the 1970s, after the breakdown of Bretton Woods, India delinked from the pound sterling in September 1975. Things were changing globally. From that point onwards, for quite a while, the exchange rate was determined by an undisclosed basket of currencies of India's major trading partners. A bit mysterious. Then came the 1990s reforms, a critical turning point. Following severe balance of payment difficulties in the 1990s, specifically the big crisis in 1991, the rupee underwent a significant two-step downward adjustment, essentially a devaluation in 1991, a stark admission of the economic pressures at the time. And then in March 1992, the Liberalized Exchange Rate Management System, or LERMS, was instituted, which was actually a dual exchange rate system for a period. Today, as you know, India operates under what's commonly called a managed float, or sometimes a dirty float. This hybrid system allows the exchange rate to be largely determined by market forces of demand and supply. The market plays the primary role. However, the Reserve Bank of India actively intervenes by buying or selling foreign currencies to ensure orderly conditions and stabilize the exchange rate, especially during periods of high volatility. It's a constant balancing act, between letting market forces work and preventing really disruptive swings that could harm the economy.
So given all that, why does a country like India even bother to control foreign exchange at all, in any form, even with a managed float? What's the fundamental motivation behind any level of control?
Well, it's primarily to protect the economic interests of the country, ensuring national stability and sovereignty. It helps manage the balance of payments, trying to keep imports and exports roughly in balance over time. It can be used to protect domestic industries from potentially destabilizing surges of foreign competition or capital flows. A key goal is to maintain and stabilize the exchange rate itself, preventing economic shocks that volatility can cause. And importantly, it aims to prevent flight of capital, especially during times of crisis, ensuring funds remain within the country for productive investment rather than fleeing overseas. It's about national economic management.
This brings us quite naturally to a crucial safeguard for any economy, its reserves. India's foreign exchange reserves. They're often described as the nation's financial shock absorber, a buffer against external shocks, right? Their main purpose is exactly that: maintaining macroeconomic stability, managing exchange rate volatility, and providing that critical buffer when things get tough globally. And the legal framework governing these reserves is set primarily by the Reserve Bank of India Act and, of course, FEMA. Now, India's foreign exchange reserves, they're just one big pile of dollars. They consist of four main categories. First, and usually the largest component, is foreign currency assets, or FCAs. These are held in a multi-currency portfolio, primarily comprising major global currencies like the US dollar, euro, pound sterling, and Japanese yen. And importantly, they're always valued in terms of US dollars for reporting purposes. Their value moves around due to RBI's own forex operations, income earned from investing these assets, any external aid received, and also revaluation changes from exchange rate fluctuations between these currencies. Second, there's gold. India holds substantial gold reserves, both domestically within India and also overseas in safe custody, with institutions like the Bank of England and the Bank for International Settlements, BIS.
And here's where it gets particularly interesting, the third component. Special drawing rights, or SDRs. SDRs are often misunderstood. They are not actually a currency themselves. They're better thought of as a unique supplementary international reserve asset defined and maintained by the IMF. The XDR, which is the unit of account for SDRs, is the unit of account for IMF transactions. Its value is derived from a basket of the world's 5 leading currencies: the US dollar, the euro, the Chinese yuan, which was notably added in 2016, the Japanese yen, and the UK pound sterling. It's essentially a composite claim on these major currencies. Now, who holds them? Only IMF members and the IMF itself hold SDRs. Individuals and private entities cannot own or trade them. A key recent highlight, which many might remember, was during the COVID-19 pandemic. To supplement members' reserves during that crisis, the IMF approved a massive general allocation of about SDR 456 billion, equivalent to around USD 650 billion on August 2, 2021. India, as a member, received SDR 12.57 billion from this allocation, which was around USD 17.86 billion. That significantly boosted its total SDR holdings. India holds about 2.75% of the total SDR quota globally.
Okay, so SEA's gold SDRs, and the fourth component is the reserve tranche position, or RTP. What exactly is that?
Right, the RTP. This is essentially the difference between a member country's quota contribution to the IMF and the IMF's holdings of that country's currency. It's a crucial part of the country's foreign exchange reserves because it represents a portion that the country can draw upon at any time without conditions or service charges. It's like a readily available line of credit with the IMF, making it a very liquid and accessible safety net in times of need.
Okay, shifting gears slightly, let's talk about the money that flows into India, fueling its economic growth. Foreign investments. These are, as you'd expect, meticulously governed, and there are key distinctions you really need to know. The regulatory framework is primarily handled by FEMA and also the Securities Exchange Board of India, SEBI, particularly for its foreign portfolio investors' regulations. Now, foreign investment is broadly defined as any investment made by a person resident outside India on a repatriable basis, meaning the money can eventually be taken back out in capital instruments of an Indian company, or LLP. That repatriable part is important. It means the sale or maturity proceeds can generally be freely transferred abroad, which is the case for most foreign investments these days.
And for these investments to actually enter India, there are 2 main pathways, or routes. First, the automatic route. This allows foreign investment without prior approval from the government or the RBI. It applies to the majority of sectors, making things simpler and faster. Then there's the government or approval route. This requires prior approval of the government of India for investment in sectors not covered by the automatic route. These are typically more sensitive or strategic areas like defense, broadcasting, or certain financial services where the government wants more oversight.
This raises an important question. How do regulators, and how should we, distinguish between an investor looking for a long-term, maybe strategic commitment versus one that's just seeking more fluid, perhaps short-term returns in India? That's where the classification of foreign direct investment, FDI, and foreign portfolio investment, FPI, comes in, isn't it?
That's the crucial distinction, exactly. Foreign direct investment, or FDI, signifies a deeper, more strategic commitment. It's defined as investment coming into an unlisted Indian company, or investment representing 10% or more of the post-issue paid-up equity capital of a listed Indian company. FDI generally implies a desire for long-term strategic interest, often involving some element of control or active management in the company. Think building factories, long-term partnerships. On the other hand, foreign portfolio investment, or FPI, is typically for investors interested in a listed Indian company where their investment is less than 10%. FPI is generally considered more short-term and volatile because it often seeks to take advantage of varying returns across different markets, maybe buying stocks or bonds for shorter periods. This is why it's often referred to, sometimes slightly pejoratively, as hot money. It can flow in and out more quickly. Interestingly, India used to have several different terms like FII, foreign institutional investor, sub-accounts, and QFI, qualified foreign investor. But these were all merged into the single, simpler category of foreign portfolio investor, or FPI, back in 2014, which streamlined the landscape considerably. There's also a key regulatory rule you should know: the once an FDI, always an FDI rule. This means if an FPI's holding in a listed company increases to 10% or more, thereby becoming FDI, it will continue to be classified as FDI even if the holding subsequently falls below that 10% threshold. This prevents frequent disruptive reclassifications. And just in terms of who regulates what, FPI is primarily regulated by SEBI, the markets regulator, while FDI is largely governed by FEMA and the RBI, the central bank.
It makes a lot of sense to differentiate that way based on the investor's apparent intent and stake size. And I understand FPIs themselves are further categorized based on risk, correct?
Yes, that's right. SEBI uses a risk-based approach. Category FPIs are considered lower risk. This category includes stable, typically long-term institutional money like government and government-related investors, think foreign central banks, sovereign wealth funds. It also includes university funds and pension funds and appropriately regulated broad-based funds like mutual funds and insurance companies from well-regulated jurisdictions. Plus, regulated entities from FATF member countries generally fall into Category 1. Category 2 FPIs, on the other hand, encompass entities perceived as having potentially moderate to high risk. This essentially includes all other FPIs not eligible for Category 1, such as endowments, charitable organizations, corporate bodies, individuals, family offices, and unregulated funds, perhaps, from less regulated jurisdictions. It's a way to tailor oversight.
Okay, so with these classifications, FDI versus FPI, and FPI categories 1 and 2, what are the specific rules and limits for these different types of foreign investment once they actually try to invest in India? Well, for FPI investments specifically in capital instruments like equity shares of a listed Indian company, there are limits. There's an individual limit, meaning a single FPI's holding must remain less than 10%. That's the threshold that keeps it FPI, not FPI. Then there's an aggregate limit. This dictates that the total holding of all FPIs together in a specific listed Indian company is subject to the applicable sectoral cap for that industry. Some sectors have caps on total foreign investment, and FPIs fall under that. Indian companies themselves also have some flexibility. They can actually choose, with board approval, to decrease the aggregate FPI limit for their company to lower levels like 24%, 49%, or 74% if they wish to maintain higher domestic ownership, for example. And the monitoring is quite active. Regulators use a red flag list. This gets triggered when foreign investment is within 3% or less than 3% of the aggregate NRI FPI limits, alerting the market that the limit is approaching. And then there's a breach list, which indicates when the foreign investment has actually reached its permissible limit, and further purchases might be restricted. It's a very actively managed system to prevent breaches.
And shifting focus slightly to the debt market, FPIs are also significant investors there. They can invest in government securities, GSECs, state development loans, SDLs, and corporate bonds, CBs. The RBI announces annual limits for these investments under the medium-term framework. For instance, the GSEC limit might be set at 6% of the total outstanding government bonds. A really significant development in recent years was the introduction of the fully accessible route, or FOLR, back in April 2020. This allows non-resident investors to fully invest in specified Government of India securities without any restrictions, essentially removing the cap for certain benchmark bonds. All new issuances of GSECs of key tenors like 5, 7, 10, 14, and 30 years became eligible under FOLR. And there are even recent proposals, as of May 2025, suggesting further easing of regulatory compliances for FPIs investing only in Indian government bonds under this RR route, signaling a continued push towards greater openness in the government bond market. Another important avenue, especially for encouraging longer-term debt investment, is the voluntary retention route, or VRR, introduced in March 2019. This is a special channel of investment designed explicitly to encourage long-term and stable FPI investments into Indian debt markets, specifically corporate and government debt. It operates over and above their investments through the regular capped route. The key incentive is that investments under VRR are exempt from macroprudential and other regulatory requirements, like concentration limits or short-term holding restrictions. But the catch is, FPIs must adhere to a minimum retention period of 3 years and maintain at least 75% of their allocated investment amount in India for that period. The overall investment limit under VRR was significantly increased to 2,050,000 crore, effective from April 2022. It's clearly an attempt to attract more stable, sticky capital into the debt markets.
Now, this is where it gets really impactful, especially with some very recent news. You mentioned recent developments. Tell us about the latest updates from just May 2025 regarding FPI debt investment, specifically in the general route for corporate bonds. I hear there were some pretty significant changes.
You're absolutely right. These are crucial developments and quite recent. 2 major regulatory caps were effectively withdrawn for FPIs investing in corporate debt through the standard general route. First, the 30% short-term investment limit, which restricted FPIs from investing more than 30% of their corporate bond portfolio in securities with a residual maturity up to 1 year, has been removed. This means FPIs can now invest in corporate bonds of any maturity without this specific restriction, giving them more flexibility across the yield curve. Second, the concentration limit, which prevented a single FPI from exceeding 15% of the total FPI corporate debt investment limit, has also been withdrawn. This gives individual FPIs greater flexibility to take larger exposures to Indian corporate debt if they choose.
Wow, removing both the short-term limit and the concentration limit. That sounds like a big deal for the corporate bond market. What are the likely implications of these relaxations?
Well, the clear aim is to deepen India's corporate debt market. By removing these restrictions, the regulators hope to make it more attractive and liquid. They're certainly designed to attract greater foreign capital inflows into this specific segment, providing more financing options for Indian companies. And from the investor perspective, it significantly simplifies compliance. Fewer rules to track makes it easier for international investors to participate. It's a clear signal of India's commitment to further integrating its debt markets globally and making them more efficient.
Okay, that covers foreign investment flowing in. Now, to round out our deep dive into India's global finances, let's explore the other side. How Indian companies actually raise funds from international markets. This is where external commercial borrowings, or ECBs, come into the picture.
Exactly. ECBs are essentially commercial loans raised by an eligible Indian company from foreign lenders. These loans can be denominated either in Indian rupees, INR ECBs, or in any freely convertible foreign currency, FCY ECBs, like US dollars or euros. The framework for ECBs was comprehensively revised and simplified back in January 2019 by the RBI. The goal was really to streamline the process and enhance flexibility, making it easier for Indian entities to tap into global capital pools.
So what forms can these ECDs typically take, and how did that 2019 revision change things?
They can take many common forms. You have standard loans, including bank loans from foreign banks. You can issue floating or fixed rate notes or bonds or debentures, though not ones that are fully and compulsorily convertible into equity. Those are treated differently. Even trade credits beyond 3 years can qualify as ECBs. We also have specific instruments like foreign currency convertible bonds, FCCBs, and foreign currency exchangeable bonds, FCEBs. An FCCB is a corporate bond issued overseas in foreign currency, but it gives the investor the option to convert it into equity shares of the issuer company later. An FCEB is similar, but the option is to convert into equity shares of an offered company, which is usually another company within the same promoter group as the issuer. Key changes in the revised 2019 framework included the general exclusion of preference shares as a form of raising ECB, although there are specific exceptions, particularly for startups, which we can touch on. And importantly, the framework did away with the earlier categorization based on maturity, like track 1, 2, 3. Now it's simplified, based solely on the currency of raising the ECB, either FCY or INR. This made the rules much more straightforward to navigate.
And who is actually eligible to borrow under this ECB route? And who can they borrow from? What kind of repayment periods are we typically looking at?
The list of eligible borrowers was significantly expanded in 2019. Now it includes all entities eligible to receive foreign direct investment, FDI. That covers a very wide range of Indian companies. Additionally, specifically for INR-denominated ECBs, entities like port trusts, units in special economic zones, SEZs, Citibai, Exim Bank, and certain registered nonprofit entities can also borrow. As for recognized lenders, generally it can be any entity that is resident of a country which is compliant with the FATF Financial Action Task Force, or IOSCO, International Organization of Securities Commission standards. This ensures the lender is from a credible, well-regulated jurisdiction. Individuals are generally not permitted as lenders, except if they are existing foreign equity holders in the borrowing company or for subscribing to listed bonds. Now, the minimum average maturity period, or MMP, is a key requirement. The general MAMA for all ECBs is 3 years. The loan must have an average life of at least 3 years. However, there are specific exceptions. For instance, manufacturing companies can borrow up to USD 50 million per year with just a 1-year MAM. But if the ECB is taken from a foreign equity holder specifically for working capital, general corporate purposes, or repaying rupee loans, the MAMP increases to 5 years. And if NBFCs borrow for on-lending for working capital or general corporate needs, the MAMP is 10 years. Similarly, borrowing to repay rupee loans for capital expenditure requires a 7-year MMP, or 10 years if repaying rupee loans for non-capital expenditure. So the purpose matters for maturity. A big enhancement for access was making it easier to borrow under the automatic route. All eligible borrowers can now raise ECBs up to USD 750 million or equivalent per financial year under this route, without needing specific RBI approval, which significantly enhances their ability to tap foreign funds quickly. And there are clear all-in cost ceilings covering interest, fees, charges, etc., to ensure borrowing costs remain within reasonable bounds, linked to benchmark rates plus a defined spread.
Okay, that makes sense. But this raises an important question. Are there any strings attached to how this borrowed money can actually be used? Can an Indian company just borrow internationally for absolutely anything?
That's a critical point, and no, they can't use it for anything. There are specific end-use restrictions, often referred to as a negative list. ECBs cannot be used for real estate activities, with some minor exceptions for affordable housing, etc., investment in the capital market, like buying stocks, or for equity investment in other companies. These restrictions are fundamentally in place to prevent the use of potentially cheaper foreign funds for activities considered speculative or perhaps less productive from a national perspective, or areas prone to asset bubbles. However, there are important allowed exceptions, but they often come with specific longer MMPs, as we discussed. ECBs can be used for working capital purposes, general corporate purposes, and for repayment of rupee loans, both for capital expenditure and non-capital expenditure. And NBFCs can also use ECBs for on-lending for these specific permitted purposes. So it allows core business activities but restricts others.
I imagine risk management, especially currency risk, is a big part of this framework too. What about hedging?
Absolutely. Borrowers raising ECBs must follow specific hedging guidelines set by the RBI. For certain categories, hedging is mandatory. For example, infrastructure companies and some others are mandatorily required to hedge 70% of their ECB exposure if the average maturity of their loan is less than 5 years. This hedging requirement covers both the principal amount and the expected coupon payments. It's crucial for managing the currency risk, especially on large, long-term projects where currency swings could derail finances. As for what borrowers can do with the money before they spend it, the parking of ECB proceeds, there are rules too. If the funds are destined for foreign currency expenditure, they can be parked abroad temporarily, but only in highly rated deposits, treasury bills, or with foreign branches or subsidiaries of Indian banks. If the funds are meant for rupee expenditure within India, the proceeds must be repatriated immediately back to India and credited to rupee accounts. They can be parked temporarily in term deposits with AD category I banks in India, but only for a maximum period of 12 months cumulatively while awaiting their final use.
It's clear the framework is quite comprehensive, trying to balance access with prudence. And I hear there's even a specific, slightly different facility tailored just for startups. That must be a huge boon for India's burgeoning tech and innovation scene.
It is, and it's a great example of targeted policy flexibility within the ECB framework. There's a special ECB facility for startups that operates under the automatic route. Eligible startups can borrow up to USD 3 million or equivalent per financial year through this route. The minimum average maturity period is 3 years, aligning with the general rule. What's particularly notable here is the form it can take. Unlike the general ECB framework, startups can raise this ECB not just as loans, but also significantly as non-convertible, optionally convertible, or partially convertible preference shares. This offers much more flexibility, closer to equity financing, which is often better suited for early-stage companies. The recognized lender must still be a resident of a FATF-compliant country, ensuring credibility. And importantly, the all-in cost ceiling is mutually agreed between the startup and the lender. There's no specific regulatory ceiling, recognizing the potentially higher risk profile and negotiation dynamics for startups. The end uses are also very broad, allowing funds to be used for any expenditure in connection with the business of the borrower, giving startups maximum flexibility. However, and this is a key safeguard, guarantees by Indian banks, all India financial institutions, or NBFCs, are not permitted for these startup ECBs. The risk has to be borne directly by the foreign lender or potentially the startup's foreign equity holders.
Fascinating how dynamic this framework is, adapting even for specific segments like startups. What's currently being discussed or developed in this ECB area as of, say, mid-2025? It's still evolving?
It's indeed a continuous evolution. As of July 2025, there's definitely an ongoing emphasis on further simplifying processes and making India's debt markets, both government and corporate, even more accessible. This is partly driven by India's inclusion in major global bond indices, which is a huge factor attracting passive foreign capital flows, and regulators want to ensure the plumbing works smoothly. Discussions are often ongoing regarding hedging compliance, finding the right balance between mandating risk management and not making it too onerous for borrowers. And a key underlying policy debate that continues is whether encouraging significantly increased ECBs might inadvertently hinder the development of a deeper, more liquid domestic corporate bond market. It's that classic balancing act. How much do you rely on foreign capital versus nurturing your own domestic financial markets? It's something policymakers are constantly grappling with.
Wow, what a deep dive indeed. We've really spanned the entire landscape of foreign exchange in India today, haven't we? From those highly controlled, almost close-off days under Farah, through the sweeping liberalization with FEMA, and then right into the nuts and bolts of the forex market, reserves, the latest relaxations for foreign investors in debt, and the dynamic world of how Indian companies borrow from abroad via ECBs. It feels like we've covered a complete picture of India's financial journey onto the global stage.
Absolutely. And if we connect all this back to the bigger picture, I think understanding these nuances, FARA, FEMA, FDI, FPI, ECBs, SDRs, it isn't just for financial experts or economists. It truly helps you grasp the pulse of a nation's economic health, its growing global interconnectedness, and also the incredibly careful ongoing balancing act involved in managing a country's financial flows in an ever-changing, often volatile global economy. It's fundamental to understanding modern India.
So, as you've been listening, what stands out to you from today's discussion? Think about how these policies, these flows of capital, influence everything from the price of the imported goods you buy to the ability of innovative new businesses in India to get funding and grow, or even just the overall stability and trajectory of the India economy. And here's a final thought to mull over. As India continues its journey towards greater global economic integration, how will these complex systems continue to balance that inherent tension? The tension between a nation's desire for stability and control versus the powerful imperative for free capital flows and attracting investment to fuel economic growth. What unique challenges and maybe opportunities might arise as India's markets become even more deeply intertwined with the rest of the world? And how might India continue to adapt its policies in response? Something to think about.